Well, hello, everybody. Steven Sitkowski here. Welcome to this week's edition of Market Insights. Hope your holidays are going well, and Happy New Year to all of you. It's been awesome being with you this last year. I hope that you feel like we've been able to make a contribution in terms of your knowledge, hence performance in the market. There was certainly a lot of opportunity this year. I hope you took full advantage. But with that, let's take a look at what's going on. Um, and my short initial response is not a lot. We had an abbreviated trading week last week, same thing this week. Volume is always down this time of year. We have seen a pretty good move today so far to the downside. And there has been some profit taking going on. This is the time of year when hedge funds, mutual funds will lock in profits on their gainers, and that tends to have a slightly negative impact. But overall, the last 5 days of December are generally very bullish. And I don't really see any major catalyst that would bring this market lower, frankly, with the one exception that interest rates have definitely ticked up and the outlook for the Fed is less dovish. That's the only thing that I can point to. But with that, let's get to it. I want you to know that everything we do here is for educational and informational purposes only. It is not intended as investment advice. So what's moving the markets? Well, the S&P is up 25%, the NASDAQ up 31% for 2024. You can't ask for more than that. Opportunity was definitely there, but it was not necessarily broad-based. It wasn't like you could just throw your money at the market and expect to make a bunch. You had to be in the right stocks, but generally that is the way the market works. It rewards those who know. Indexes are headed for their fourth winning quarter. So in spite of this little bit of a pullback that we're experiencing, 4 quarters, all higher. And yet there are people that I talk to occasionally that want to tell me what a tough year this has been. I mean, really? I've been through tough years. This wasn't one of them. Santa's late to the rally. So have you heard of the Santa Claus rally? Those are the last 5 days that I mentioned previously. Not so much. So, maybe tomorrow's well, that's the 31st. I don't see a whole lot happening here near term. The 10 years come down a little bit. It got to 4.6. Now it's at 4.553, so that's a bit of an improvement. Stock market likes low interest rates. It eliminates the competition from bonds and CDs, and it lowers one of the primary costs that many big companies face, and that is debt service. And oil prices are at 71.25. They've actually ticked up just a little bit since last week. What are we watching this week? There's just not much going on. So today we have the Chicago Business Barometer coming out. That's not going to move the market. Tomorrow we have Home Price Index. That's not moving the market. Then we have New Year's Thursday initial jobless claims. Those came in pretty low last week at 219,000. We're expecting 225, but this typically isn't the time of year where employers like laying off employees. So I'm not sure we'll see much of a boost to that number. And then the manufacturing number comes out on Friday. Biggest market mover in the group is initial jobless claims, but it's frankly not much of a catalyst. This is last week's heat map. Looks like a little more red than green, and the only thing really bright green was Broadcom. Other than that, pretty muted. Now, if you want to step back and look at the year, oh, there were winners all over the place. Costco, Walmart. I mean, Walmart was up 72%. I was doing covered calls on it this year. Meta, which I'm also doing covered calls on, 64%. Alphabet, 35%. Lilly, 33. Amazon, 43. Apple, doing covered calls on it, up about 30%. Microsoft, doing covered calls on it, up about 13%. Really an underperformer. NVIDIA, doing covered calls on it, 172%. And Broadcom, 106%. So there was plenty of money to be made this year. Market sentiment has fallen off for sure. So look at the historical average for the percentage of individual investors who believe the market will go up over the next 6 months. So historically, we're at 37.5%. Right now, we're at 37.8. But look at the bearish. Normally, 31% are bearish. And where are we now? 34%. So that's not great. And look at the trend. 48% bullish, 43, 40, 37. So, things have decidedly changed as of the last month, but nothing really fundamentally has changed other than we are definitely a little more hawkish relative to the Fed, and we'll take a look at what the latest probabilities are on that. And here we go, right on cue. How much is Fed going to cut? Well, now we're looking for 2 rate cuts. It was down to 1. So at the next meeting, January the 29th, there's about a 90% probability no rate cut. And then it's like 50-50 chance that we'll get one in March. This will all be data dependent. Lower interest rates are good for stocks, but in order to get lower interest rates, we need the economy to cool a little bit. And that's not been happening. So that's kind of where we sit. So I watch this literally day to day. 1 year sector returns, S&P for the year up 23.51%. That includes today's drawdown. Big winners were communications, technology, discretionary, and financials. A step down from that, utilities, industrials, and staples. And then coming in with basically a checking account return, healthcare, energy, REITs, and materials actually lost. Take a look at the charts. See what they've got to say. Let's look at the SPX. We've just dropped below our 50-day moving average. So the question will be over the next week, can it recover? I mean, it's a really good looking chart. This is a 6-month chart. That yellow line is a 50-day moving average. You can see it is still sloping upwards, which is bullish. We did get below a little bit and then it crossed above. Now we're below a little bit. We'll see what the next move is. We're much more comfortable that we're in a bullish market when A, that 50-day is sloping higher, but B, that the S&P is trading above its 50-day, which for today, it is not. How the Q's looking? It's a NASDAQ 100 Trust sitting right on its 50-day moving average. So we're kind of at an inflection point here. We're neither bullish nor bearish. I really think that all of the data points to a really good 2025 next year between quantum computing, AI, other advancements in technology and robotics. I think that's going to be leading the charge. I have no doubt that 2025 is going to be an up year in the market. We've had a really successful year with our trade ideas of the week on 103 closed trades. Average return has been 17.8%. Average hold 16.6 days. So it doesn't take a math genius to realize, wow, that's about a return of 1% per day. Past performance is not a guarantee of future results, but um, it's a pretty good indicator that we got a good hold on this market. Our win percentage 93.3%. I think in 2023 we finished around 92% winning trades. So the kinds of things we talk about, I just want you to know, translate into the real world if in fact, you've got the knowledge. So, all right, there you have it. Appreciate spending a little time with you once again. And to repeat, have a fantastic new year. Be safe, be smart, right? Making intelligent decisions begins with what we do on New Year's and then moving forward. I'm also sure that for a lot of you, as you sit down and start to map out your New Year's resolutions, a big part of that will have something to do with finances. It's one thing to say, I want my financial life to improve. It's another thing then to have a game plan that allows you to do it. And that's critical. It's the difference between dreams and goals. So, my best to you and yours in 2025. And I'll be seeing you soon. Bye for now.